The US reached a trade agreement with China towards the end of the quarter, which sent stock markets rallying to new all-time highs. Here in the UK, the Conservative leadership election was ongoing between Boris Johnson and Jeremy Hunt, neither of which would rule out a no-deal Brexit, which kept sterling low over the period. Over in Asia, the Indian elections were held and Narendra Modi was re-elected with an improved majority, which should see the country continue its impressive growth. Bond market values rose over the quarter as the US Federal Reserve implied that the first of the interest rate cuts could come as early as August this year. Valuations in Europe rose considerably over the period as their economic data continued to deteriorate. We hold US, European and UK government bonds within our defensive portfolios to act as a shock absorber in negative equity markets. While trade wars, Brexit and interest rates have dominated the news recently, we continue to rely on economic data as our main gauge for the health of each market. Data in the UK and Europe has deteriorated recently, but the US and Asia has been much more resilient. That is why, in our portfolios, we have a much greater allocation to those areas. We've enjoyed a fruitful period in portfolios so far this year, and we have been decreasing risk. We remain defensively positioned, but signs of market weakness are creeping in. That said, with lower interest rates in the US and further stimulus from Europe and Asia potentially, we could see growth continue well into next year. We've seen some positivity in our UK-based assets, such as oil refineries. However, there have been some disadvantages for India and Japan, which are large importers of oil. However, these regions have continued to do well this year.